Hey guys, I hope your week is off to a great start. This is Kyle again with another Tax Talk Tuesday, and today I wanted to talk to you about a tax planning strategy that we've seen save some of our business planning clients a lot of money in the past. Really, who doesn't like the sound of that? So what are we talking about? Well, today we're going to scratch the surface of a process that's called cost segregation. Now, if you look this up online, you're going to see that cost segregation is a process of identifying and reclassifying personal property assets that are grouped with real property assets to shorten the length of depreciation time for income tax purposes. Now, what does that really mean? Essentially, someone's going to come into a physical location of your business and determine if there's any property or improvements that can be depreciated quicker than the building itself. That's going to give you, the business owner, an accelerated timeline to utilize certain depreciation deductions. Higher deductions means lower taxable income, which should help you put more money back into your business, perhaps expand to another physical location and utilize the cost segregation process again. So how does this work? Well, if you're a business owner whose business owns certain real property, you're probably depreciating that property over a 27.5 or a 39-year period. By isolating and reclassifying, though, certain personal property or improvements within the business, that reclassified asset, or these reclassified assets, I should say, can be expensed over a 15-year, a 7-year, or maybe even a 5-year period. So to depreciate these assets on a shortened time horizon, the assets need to fall within the Internal Revenue Code definition of personal property or a land improvement. So let's say you're an engineering company, maybe you purchased a furnished office space and some of the furniture or existing equipment, basically you were going to depreciate it along with the cost of the business. Well, you could potentially segregate that out as personal property and depreciate that separately than the depreciation on the building itself. Maybe you own a construction business and recently built a new office building, added some landscaping, parking lots, a sidewalk, some stairs, maybe even a fence. That can be depreciated separately from the building itself, has a different useful life. Cost segregation, it's really more beneficial for recent construction. That doesn't mean you can't use it if it's an older building. Perhaps there's some catch-up depreciation that you could take there. So again, what we're looking for here is trying to segregate certain assets from the building itself, depreciate them quicker, resulting in a higher deduction. There are some costs associated with this, and they can be significant, and perhaps the biggest thing to be aware of is that performing a cost segregation study is often an expensive process, or it can be an expensive process. So weighing this out, making sure that there is some reward in it for you is important. And just another thing to be aware of is if you do take these shortened timelines for depreciation and then later sell some equipment, you are potentially opening yourself up for what's called depreciation recapture. And again, we want to avoid that if we can, or we at least need to be aware of it. But as with anything in the tax field, there's always risk and reward. The trusted advisor can help you determine whether this might be an option for you. It can help you through the documentation. This does, quite frankly, I hate to use the word, but it is subject to audit. It can create an audit risk, and we just want to make sure that we're backing everything up there that we can. But like always, if you have questions for us, feel free to connect. We'll connect you with the right people. Again, cost segregation, hopefully a way that could save you some money. Hope you have a great Tuesday. Thanks.